Welcome to the weekly review of the markets for week ending March 1st, 2019 from Hernandez Retirement Services. This is Agustin Hernandez. Before we begin, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is the forecasting of future financial price movements based on an examination of past price movements and cannot predict the future. Technical charts referenced are subjective. No strategy can ensure success or protect against losses. International markets involve special risks such as currency fluctuation and political instability. These risks are often heightened for investments in emerging markets. International investing may not be suitable for all investors. Investing involves risk, including loss of principal. Sector investing will be subject to greater volatility than investing more broadly across many sectors and companies. On this week's agenda, the S&P had another positive week, but is momentum slowing? With the rally in 2019, what percentage of stocks in the S&P are above their 50 and their 200-day moving averages? One of the leading sectors in the recovery has been infotech. We will look at infotech in two groups inside of this sector. Brazil had a pullback. How does it look now? Is the bullish pattern over the 10-year U.S. Treasury note over? Finally, we end with, what does this mean? This week, we get back to the S&P daily charts. We feature both the candlesticks and the MACD. I wanted to include the candlesticks because it gives more details on a day-to-day basis of price action for the index. We have a green for an up day and a red for a down day. I also included the MACD, which is a momentum indicator based on two separate moving averages, so we can get a positive or negative momentum signal. Now to the price chart. First, let's keep things in perspective. The rally has been impressive, but we are still a little over 4% from the highs of 2018. No long-term bull run can begin without its previous high not being taken out. What we have is price above both its 50-day and 200-day moving averages, and that is good. But weekly gains have been harder to come by over the last 2 weeks, and we seem to be bumping into resistance around the 2015-2016 price range. This line seems to be the first true test of strength of this rally. And while we have a positive rise in 50-day and the 200-day has not sloped down, this index needs more work. A break above the old highs and a positive crossover by the moving averages would be a good start. Now, as we see price stalling a bit, let's see what momentum is telling us. And as we see below the price chart, the MACD momentum indicator has been weakening over the last month. Yes, price has been rising, but not at the speed it did in late December and early January. Now, this short-term negative weakness does not mean the rally is over. It may just mean that a pause and a possible small pullback is coming. Let's keep an eye out and see if this pullback on the S&P is coming and whether it has the strength to hold on at least to its 200-day moving average. Speaking of moving averages, I thought it'd be a good time to see what percentage of stocks in the S&P are above their 50-day and 200-day moving averages. The top chart shows the percentage of stocks in the S&P above their 50-day moving average. And as of last Friday, that number was 91.6%. That is a big number. It is just shy of its high of 92.4 reached a few days before. Now, let's look back over the course of a year plus and see how this current percentage stacks up. During a major rally in January of 2018, the percentage of stocks above their 50-day hit 84.2%. A short time after that, the S&P began a major pullback and only 13.6% of stocks were above their shorter term moving average. As the market began its recovery, we see the percentage increase until September when we hit 76 and 73% before the beginning of the next leg down. October saw the initial fall, recovered a bit in November, and then hit a low of 1.2%. Now, like the 92.4% number, this 1.2% number seems to be a short-term extreme effect. But we have to remember, December was a month of fear and uncertainty. It shows how 2 months can change a narrative. But remember, this is a shorter term indicator. Let's look at the longer term 200-day. Now here we see a correlated indicator to the S&P price. The original high was hit in January of 2018, which means though price was lower than the September peak, more stocks were participating in this rally. Now currently we have 64.6% of stocks above their long-term trend moving average. It is a good sign to see this, but we don't get a full picture based on this. One, how far are these stocks above their 200-day line? Also, is the 200-day line for these stocks sloping up, down, or flat? That matters as we want price rising on a rising 200-day line. For now, let's take it for what it is. Encouraging, but not an indicator that can tell us if this recovery is complete. These types of indicators play more of a supportive role, but being a half full glass guy, it is better than being at the lows of December when we're at 10.8%. The last couple of weeks I have shown the tech sector has been a leading part of the US equity markets. Here we see the NYSE Information Technology Index chart, and it is telling us quite a bit. First, price is above both its 50 and 200-day moving average. That is a good sign. Also, just recently, this index had a positive crossover when its 50-day went above its long-term 200-day moving average. Also positive signals. Now, to the Debbie Downer portion of this chart, price has been under short-term downside pressure. It peaked out in early January, and the recent highs have been lower. For now, the good news, despite the pullback, is that it has yet to breach below its 200-day and 50-day moving average. So though we had a positive crossover, it is on falling price. Looking below price, we also see the MACD momentum indicator in yellow, which is negative momentum. So this leading sector has hit a bump on the road to a bull run. This is where the fight will begin. If there is more of a pullback, how much? Will price go below both moving averages? Will the moving averages invert negatively? Or will this index puff out its chest and hold strong and begin a recovery? As I have said in several videos, we are getting close to the decision for the US equity markets. Now, we just saw a leading sector with short-term weakness. But what about the groups inside, the subsectors? Here I show the S&P Software Industry Index. Like the tech sector, price is above both its 50 and 200-day moving averages. Also, here we are seeing a possible positive crossover of the moving averages, another positive sign. But what we see differently is that price continues an upward pattern. Yes, it has had small pullbacks, which is good and healthy as long as price breaks out higher. Looking at the MACD, unlike the S&P and the infotech sector, we see positive momentum. So this group has defied the short-term weakening of momentum to power higher. Now the question is, will it stand alone while the rest pull back? Will it lead the S&P and the other US equities into a bullish run? Or will it also succumb to the short-term pressure of the S&P momentum? Another subsector of the Infotech Index is the Semiconductor Group. Now this group has been one of the popular groups with such previous high flyers as Nvidia and AMD. Now with such high flyers also comes a harsh drawdowns. This group saw a drawdown of over 25% from mid-September until late December. Like the rest of US equity markets, it has enjoyed a nice recovery and now price is above both of its major moving averages. Like the S&P, we see the 50-day rising and the 200-day flattening. So based on price and the moving averages, there is still more work to be done. Looking at the MACD, we see momentum slowing down from early February and finally turning negative this week. Again, a weakening of momentum itself is nothing bad. The key here is whether this pullback will pull this group below both moving averages. A pullback that stops near its 200-day may be a healthy pause before a next rise, at which point we could have rising price with a positive moving average crossover. We are very close to the answer of whether this is a sustainable rally. Last week, both the US dollar and interest rates rose. With that, several emerging economy stock markets had a loss. The one we are interested in is the Bovespa Brazil Index. Again, the only reason I put this in the videos is because it is one of the few indices in the global equity markets with a bullish pattern. Now, last week, this index lost 2.35%. Now, despite that, price remained above both its rising 50 and 200-day moving averages. It is still in a bullish pattern. And this index has had the type of action recently, where it hits a high, bounces a bit, falls just below its 50-day, and begins a new leg up. This is a turbulent bullish run for this index. Right now, this pullback is nothing more than an ordinary pullback. Now, the MACD shows us that this index has been in weakness for most of February. So having said that, this index has held well despite weakness in momentum. At some point, momentum will change. Will it repeat its pattern of strength, weakness, and then rise again? If it does not need much to push past the old high reached earlier this year. Our final chart is the 10-year US Treasury note. As stated for several weeks, there was weakness in price and the 50-day was beginning to slope down. Now, last week, this index broke below its 50-day. It has not been below its 50-day since early November. Does this mean that this rally is over? Not at all. It is something to keep an eye on. Now, its MACD has been negative since early January. But at that point, the US note was already in a bullish trend. So, despite momentum headwinds, the index has only lost a little over 1.5% from its high. This index seems inversely linked to the S&P, so they are both near breakout or failure. What does this mean? As I have stated in previous videos, the rally from the lows of December for the US equity markets has been impressive, but it has been a rally from a bearish pattern, a rally from a major drawdown. The key is whether this is sustainable for a long-term bullish rally. That has yet to be answered, but at least we are getting closer. The weakness in momentum may be a blessing in disguise. A pullback at any of the major US stock market indices may be able to shine a light on whether this is the beginning of a bullish pattern or the end of a bear rally. Can a major index like the S&P survive a pullback? In sports, even bad teams go on major winning streaks, but when they begin to lose momentum and lose a couple in a row, how do they react? Do they surprise and take it on the chin, regroup and trudge along to be a legit winner? Or will it show its glass chin when faced with a couple of punches? We are getting closer to that answer based on the slowing of momentum of the S&P. The Fed may have been the catalyst for both the fall and rise of the US equity markets, but it will be the traders and investors who will decide whether to shrug off any possible pullback, any resistance. The good news is that we seem to be close to be getting an answer to that question. I would like to thank you for viewing this video, and I hope it was helpful. Please like and subscribe to my channel for future videos.